Welcome to the Daily Update Podcast, where I'll go over the action in the market for Tuesday, May 20th, and we'll see how things look for Wednesday, May 21st. Looking at the market performance for Tuesday, the S&P 500 closed the day down 0.39%, marking a slight down day with below average volume. The index continues to consolidate sideways, finding support at the S1 level at 59.17, before late-day buying helped trim losses. The S&P 500 danced around the daily pivot at 59.43 but couldn't hold above it by the close. Looking at the overall health of the S&P 500, despite this recent softness, the S&P remains in good health. The sideways movement or mild declines we're seeing are working off overbought conditions, allowing the market to catch its breath. However, a stronger wave of selling pressure could signal a shift in market character, so we'll be watching closely for any signs of increased downward conviction. Going through some technical indicators. In the short term, the S&P 500 is trading above its 20, 50, and 200-day moving averages, signaling positive trends across the short, intermediate, and long-term horizons. Indicators such as the StochRSI, Williams %R, CCI 20 remain positive, showing good upward momentum, but other short-term indicators are still extreme positive, which means they're flashing overbought signals. Notably, the 20-period moving average is quite far away from current price, hinting at a potential mean reversion in the near term. Looking at the intermediate term, momentum oscillators such as the PMO and CMB composite are at extreme positive levels, reflecting strong market momentum. The McClellan Oscillator and Summation Index also show strength, but are continuing to exhibit negative divergences, which could suggest some cracks in the rally. Bullish percent indexes for both the S&P and NASDAQ 100 are extreme positive, pointing to potential exhaustion in the current uptrend. As far as the long-term trend, the S&P remains above its 200-day moving average, but it's currently in a downtrend. The 10-year Treasury yield is sitting at 4.48%, just below the 4.5% threshold where stocks have recently shown sensitivity. This is a key level to monitor for any impact on equity valuations. Going through the sectors, defensive sectors took the lead on Tuesday, with staples, utilities, and healthcare outperforming, while growth-oriented sectors such as tech, discretionary, and communication lagged. Notably, the so-called Magnificent Seven stocks, a key driver of market gains in recent years, are down 5% year-to-date in 2025, underperforming the S&P 500's modest 1% gain. Switching over to sentiment and volatility, market sentiment remains positive, with a reading of 69, down slightly from 71 seen last Friday. Caution should be advised if we climb above 75, as it often signals excessive optimism. The VIX, or fear gauge, is still below 20, indicating a relatively calm market when compared to recent market movement. High-yield spreads are tight, suggesting no immediate concerns about a recession on the horizon, according to the bond market. Now going through economic and geopolitical factors, no major economic reports were released on Tuesday, leaving the market to digest only ongoing uncertainties. The reconciliation bill in Congress continues to create some hesitation among investors, and the dollar index fell back below 100, which could influence market dynamics going forward. Switching to intraday action, the market opened lower and lacked sufficient intraday swings, chopping around the daily pivot before a late-day wave of buying helped mitigate losses. It was a relatively quiet session, but that late-day strength is worth noting as we look ahead. Switching to the outlook for Wednesday, May 21st, the bias is that we're approaching Wednesday with a mixed bias. The late-day buying on Tuesday provides some optimism, but the overall down day keeps us cautious. The only scheduled economic data will be the Mortgage Applications Index, which is unlikely to have any impact on the market. Seasonality. Post-options expiration, seasonality is positive. However, historically the Dow leans negative, while the S&P and NASDAQ are neutral to slightly negative. Key levels to watch. The 5,900 level for the S&P 500 is acting as support after recently breaking above this level. Holding this level will be key to maintaining the bullish structure. Trends to monitor. Continued consolidation would be ideal for working off overbought conditions, but the intensity of any potential pullback will be critical. The growth to value and discretionary to staples ratios remain in downtrends but are holding above their moving averages, suggesting a possible trend reversal if momentum builds. In conclusion, the S&P remains positive across short, intermediate, and long-term timeframes, but it's currently stepping back from overbought levels. A period of sideways consolidation or a mild pullback would be healthy. I'll be closely monitoring selling pressure and geopolitical developments for a more significant shift. I hope you found this podcast helpful. For more in-depth analysis and commentary, the full-length daily video update is available on YouTube and Rumble right when the market closes each day. To access the videos immediately after they are available or to access the daily newsletter, please click on the links below.